What if I told you that you could perfectly predict the stock market? Like, imagine you have a crystal ball.
Right.
You know with 100% absolute certainty that a massive tech company is going to report record-shattering profits tomorrow.
A literal sure thing.
Exactly.
Yeah.
So, armed with this perfect knowledge of the future, you take your hard-earned money, you buy an option contract, betting the stock will go up, the earnings report drops, the stock does go up exactly like you knew it would.
But you still lose money.
You lose every single penny of your investment. Welcome to the deep dive.
It sounds like a paradox, honestly. I mean, it sounds like a rigged game.
Totally.
And yet what you just described is the exact scenario that plays out for thousands of retail traders every single earnings season. They are dead right about the direction of the company, and they still get completely wiped out.
Yeah, and if you're listening to this right now, you might be screaming at your dashboard like, how is that even mathematically possible? And that is exactly what we are unpacking today.
Yes, we are.
We are stepping right into the absolute mania of the financial markets. Specifically, we're looking at the roaring, frankly terrifying AI bull market of May 2026.
It's a fascinating time capsule, really. I mean, we're looking at a market that is just bursting at the seams. The AI supercycle is creating these massive valuation disparities.
It's everywhere.
Right. And we're looking at a stack of sources today that detail the real-time application of a highly specific, high-reward, but incredibly perilous options trading strategy.
Yeah, the post-earnings announcement drift.
Exactly, what Wall Street calls PD. And our sources are tracking its deployment across the major AI semiconductor and software stocks right now.
Right. Our mission today is to completely deconstruct this strategy. And the premise outlined in our sources is just wild because it requires you to act entirely against your human instincts, you know.
Very much so.
It's the strategy of buying call options the day after a tech giant posts explosive earnings.
After the news is out.
Yeah. You were intentionally waiting for the news to become public. You're betting on continued upward momentum after the initial fireworks have already gone off.
Precisely. And what this strategy reveals about the modern market is profound. I mean, it's not just about company fundamentals anymore.
No, not at all.
It's not just about whether an AI chip is rendering faster or, an enterprise software suite is more efficient. To survive in this market, you have to understand the underlying plumbing.
The plumbing, right.
You have to understand the mechanics of how massive institutional funds move capital, how the options market prices risk, and how retail FOMO, the fear of missing out, distorts asset pricing to the point of absurdity.
Okay, let's unpack this. Because when I first read through the sources, my immediate thought was surfing.
Surfing, I like that.
Yeah, using this P strategy is exactly like a surfer trying to catch a massive, monstrous wave. If you paddle in too early, right as the wave is breaking, which is the moment the earnings announcement hits the wire, you get crushed by the initial impact.
You wipe out.
Exactly. The turbulence just rips you apart. But if you wait for the exact right moment, just behind the break, the water smooths out and you can ride that massive institutional momentum all the way to the shore.
That's a perfect visualization. I mean, the amateur trader paddles in before the wave breaks, hoping they don't get destroyed, right?
Yeah, just praying.
Hoping the wave carries them. But the professional sits on their board, observes the break, calculates the momentum, and catches the drift safely behind the chaos. But jumping in blindly on day one, right at the opening bell when the news is fantastic, is almost always a fatal mistake.
Which honestly feels so counterintuitive. Let me push back on this a little bit.
Go for it.
We are constantly taught the efficient market hypothesis in Finance 101, right?
Right. The classic theory.
The idea that all known public information is instantly triced into a stock. If an AI company announces at 4:00 p.m. that they just doubled their revenue, shouldn't the stock instantly gap up to its new mathematically correct valuation overnight, open at 9:30 a.m. at that perfect price, and just, stay there?
In theory, yes.
So why on earth would there be a multi-day drift, like even now, in May 2026, with quantum-adjacent supercomputers and high-frequency algorithmic trading? You'd think the computers would correct the price in milliseconds.
It raises a really important question. And the answer is, the efficient market hypothesis is a beautiful theory on a chalkboard, but it breaks down completely when it meets the physical limitations of market liquidity.
If physical limitations.
Yeah, so let's define the classic PED phenomenon. Post-earnings announcement drift. When a mega cap company posts a massive earnings surprise, the stock does not instantly find its true ceiling on day one. It tends to drift upward for days, weeks, sometimes even months.
Because the computers can't move the money fast enough.
The computers know what the price should be, but they can't instantly move the actual capital to make it happen. Think about the constraints of institutional rebalancing. Let's use a real-world example. Imagine a massive state pension fund or a global mutual fund. They manage hundreds of billions of dollars. If an AI chip maker suddenly proves their growth is accelerating far faster than anyone modeled, that pension fund's portfolio managers realize they are desperately underallocated.
They need more shares.
Exactly. They might need to increase their position by, say, 10 million shares to meet their new target weight.
But they can't just log into their brokerage account and click buy 10 million shares at 9:30 in the morning.
No, absolutely not. Because if they did that, they would single-handedly obliterate the order book.
They'd blow it up.
They would spike the price so astronomically high that their average purchase price would be ruined. They would literally trigger every circuit breaker on the exchange.
So it's basically a physics problem. It's like trying to pour a gallon of water through a tiny kitchen funnel.
That's exactly what it is.
The market is the funnel.
Yeah.
You can only push so much volume through it per minute without it completely overflowing.
Right. The institution has the gallon of water, and the daily trading liquidity is the funnel. So what do? They hand the order to a VWAP algorithm.
A volume-weighted average price algo.
Yes. This computer program breaks that massive 10 million share order into thousands of tiny microscopic buy orders. It drips them into the market steadily over the course of days or weeks, buying constantly on every little dip.
Ah, okay.
This relentless, hidden institutional buying pressure is what actually creates the drift.
It's just a steady upward current beneath the surface of the water.
Right. And then you have the second driver, the analyst upgrade cycle.
Oh, right, the banks.
When a complex tech company drops earnings, the big sell-side banks, Goldman Sachs, Morgan Stanley, JP Morgan, they don't instantly publish their new valuation models at 4:01 p.m.
Because they actually have to read the 10Q filing.
Yes.
They have to listen to the 2-hour earnings call, hear the CEO's forward guidance, and physically update their massive Excel spreadsheets.
It takes time. It takes them 1 to 3 days to crunch the new numbers, run it through their compliance departments, and release their official new price targets to their institutional clients.
Ah, I see the domino effect now.
Mm.
Day 1 is the earnings pop from the initial surprise. Day 2 and 3, the Goldman Sachs and Morgan Stanley notes hit the wire saying, we are raising our price target from $150 to $200.
Exactly.
And that triggers a whole new wave of buying from the Tier 2 funds and retail clients who follow those specific analysts.
It's a self-sustaining feedback loop of positive momentum. The fundamental data improves. The institutions start their algorithmic buying. The analysts upgrade the stock, which triggers more buying, which pushes the stock up, validating the analysts. That is the anatomy of a drift.
Wow. Okay, but here is where we have to dive into the absolute nightmare scenario I mentioned at the beginning of the deep dive. The paradox.
Okay.
Yeah, because our sources dedicate a massive amount of ink to warning us about the day after earnings trap. If a retail trader wakes up, sees a stock cap up 15% in pre-market trading, and their instinct is to instantly buy naked call options right at the opening bell to catch the ride, our sources say that is financial suicide.
It is.
Even if the stock drifts higher over the next week, why? Why do they lose?
Because of the single most destructive force in retail options trading, 4V crush.
Implied volatility crush.
Yes. This is the mechanism that wipes out the trader with the crystal ball. To understand why, we have to unpack how an option contract is actually priced.
Okay, let's get into the mechanics.
An options premium, the price you actually pay to buy it, is made of two components. The first is intrinsic value. That's simple math. If you have the right to buy a stock at $100 and the stock is currently trading at $110, your option has $10 of intrinsic value.
Makes sense.
But the second component is extrinsic value. And extrinsic value is made of two things: time and volatility.
Okay, time and volatility.
Before an earnings announcement, the market is completely blind. Nobody knows what the CEO is going to say. Will they announce a massive AI breakthrough and the stock rockets up 20%?
Or will they announce a supply chain failure and the stock plummets 20%?
Exactly. Because of this massive binary uncertainty, the options market gets incredibly nervous. The implied volatility of the SE expands exponentially. And because IV is a major component of extrinsic value, The price of the options skyrockets.
Right, so the options are artificially bloated. They're incredibly expensive because everyone is paying a massive premium for the sheer unknown.
Yes.
Buying a call option right before or in the chaotic first minutes right after earnings is basically like buying hurricane insurance while a Category 5 hurricane is currently hovering directly over your living room.
That is a brilliant way to frame it.
The insurance company knows the risk is at its absolute historical maximum, so the premium they charge you is astronomical.
You are paying top dollar for peak uncertainty. Now, let's follow the timeline. The clock strikes 4:00 p.m. The earnings report is released. The CEO speaks. The numbers are public. What happens to the uncertainty?
It vanishes. The market now knows exactly what the numbers are. The hurricane is past.
Instantly. The implied volatility collapses. It crushes. The mathematical models pricing the options aggressively re-rate the volatility down to normal levels. And when YV collapses, the extrinsic value of your option contract shrinks violently.
So if I'm the trader who bought at 9:30 a.m. the day after earnings, I pay the absolute highest premium possible. Let's say the stock drifts up 2% that day because of institutional buying. I'm right about the direction.
You are.
But the volatility component of my option drops by 60%. The net mathematical result is a massive bleeding loss in the actual dollar value of my contract.
Precisely. You didn't just bet on direction. You bet on direction and velocity, and you completely overpaid for the ticket. The intrinsic value gained a few pennies, but the extrinsic value lost dollars.
That's brutal.
The psychological devastation of that is immense. You are sitting at your computer, watching the stock ticker go green. The company's doing great, but your brokerage account is deeply in the red.
It feels like the market makers are actively stealing from you?
It feels that way, but it's just pure mathematics. And that's not even factoring in the second enemy in the extrinsic value equation, theta decay.
Theta. Time decay. I always think of theta like renting a luxury hotel room.
Okay, let's hear it.
If I book a room for 30 days, the reservation holds a lot of value. If I need to transfer that reservation to someone else on day 5, I can still get most of my money back. But if I wait until day 29, the reservation is essentially worthless to anyone else.
Because the time is almost up.
Right. The value of the time left just evaporates the closer you get to checkout.
Exactly. Theta is the daily tax you pay for holding an option. The closer you get to the expiration date, the faster the option loses value just because the clock is ticking.
And people love short-term options.
Amateur traders love to buy short-term, weekly options because they are cheap. They want to gamble on the earnings momentum expiring this Friday. But the theta decay on a weekly option is incredibly aggressive. It is an exponential curve.
So you are fighting a brutal, unwinnable war on two fronts. The Ivy crush collapses your volatility value instantly, and theta decay slowly bleeds your time value to death every single hour you hold it. Paddling into the wave as it breaks is just guaranteeing you drown.
Which is why the sources don't just tell us what not to do. They lay out a very specific professional blueprint. A refined PED strategy designed to entirely avoid the IVCRA, survive the theta decay, and safely capture the institutional momentum.
And what's fascinating here is how methodical, almost robotic, this blueprint is. The sources break it down into 3 non-negotiable pillars. This isn't a 50-50 blind box gamble anymore.
No, not at all.
If you execute this flowchart with absolute cold-blooded discipline in a strong bull market, the sources suggest this strategy carries a 65% to 75% historical win rate. That is an enormous edge in options trading.
It is a massive edge, so let's deconstruct the blueprint. Pillar 1, the trigger. You do not deploy this strategy on just any stock that has a good day. The setup must be pristine.
Right. Pillar 1 requires 3 specific conditions to be met simultaneously. First, the day 1 earnings pop must be massive. We're talking greater than a 10% jump in the stock price. Why 10%? Why isn't a 4% bump good enough?
Because a 4% move is just statistical noise. It can be caused by random market fluctuations or a few mid-sized funds rebalancing. A move of greater than 10% on a mega-cap tech stock requires billions of dollars of capital to change hands.
It's undeniable.
Exactly. It confirms that the broader market universally recognizes the earnings report as a major fundamental shift in the company's valuation.
Okay, second condition. The trading volume on that massive pop day must be 3 to 5 times the normal daily average.
This is the forensic footprint of the institutions. If a stock pops 10% on normal volume, that might just be retail traders getting overly excited on a message board.
A flash in the pan.
Right. But retail traders cannot generate 5 times the average daily volume on a $100 billion company. When you see 3x to 5x volume, it is mathematical proof that the whales The pensions, the sovereign wealth funds, the mega mutual funds have entered the chat. They are trying to force that gallon of water through the funnel.
And the third requirement for the trigger is the narrative piece. The company must provide what Wall Street calls beat and raise guidance, meaning they didn't just beat the past quarter's expectations, they raised their official forecasts for the future quarters.
Crucial distinction.
I want to linger on this because why is that specific combination so vital? Let's say an AI company just absolutely shattered their Q1 earnings. They made double what anyone thought, but their guidance for Q2 is just normal, flat. Why does the market punish that? Why isn't the massive historical beat enough to trigger a drift?
Because the stock market is a forward-looking discounting mechanism. It does not care about the past. Think about driving a high-performance car. The past quarterly earnings report is the rear-view mirror. It tells you exactly where you've been and how fast you were going.
Okay.
The forward guidance is the windshield. It tells you what the road ahead looks like.
Oh, that makes perfect sense.
If a company crushes past earnings, a beautiful view in the rear-view mirror, but gives flat guidance for the next quarter, they're basically telling the market, there is a massive traffic jam ahead.
So the growth is over.
The market assumes the growth has officially peaked, the best days are behind them. Therefore, there will be no multi-day upward drift because there is no future growth to price in. The institutional VWAP algorithms will not be turned on to buy the stocks.
You need both.
You need the rearview mirror to validate execution and the windshield to be completely clear so you can hit the gas.
Rear view mirror versus windshield. Okay, so a stock hits the scanner, it's up 12%, volume is 4x normal, and they beat and raised. Pillar 1 is complete. Now we move to Pillar 2, the consolidation. And from reading the sources, this seems to be the absolute heart of the strategy. This is the part where you have to fight every single human emotion in your body.
Pillar 2 is precisely where the professionals separate themselves from the amateurs. After that massive day one pop, you do absolutely nothing.
Nothing.
You sit on your hands, you close your trading terminal, you wait for 2 to 3 full trading days for the stock to pull back, or at least move sideways to consolidate.
If you're a retail trader suffering from AI FOMO, watching a stock rip 12% and intentionally doing nothing feels like physical agony.
It is agonizing, but you must wait, because during this 2 to 3 day pullback, you are obsessively tracking one specific metric, volume decay.
Walk us through volume decay. Why is a drop in trading volume during a price pullback the ultimate green light?
Because volume tells you who is in control of the price action. Let's trace the psychology. On day one, the stock pops 12% on 50 million shares traded. Massive institutional buying.
Right.
Now, day 2 and day 3 happen. The stock naturally dips 2% or 3%. Why is it dipping? Because short-term retail traders and day trading hedge funds who bought before earnings are taking their quick profits. They are selling.
Right, they made a quick buck, they're out.
Exactly. But as a momentum trader, you want to see that dip happen on drastically lower volume. The sources specify you want to see the volume shrink to ideally less than 30% of the day one volume.
So a huge drop in volume.
Yes. So if day one was 50 million shares, you want to see day 3 volume drop to 10 or 15 million shares.
Ah, because if the volume drops off a cliff while the price is dipping, it proves that the big money isn't participating in the sell-off. The massive mutual funds aren't dumping their shares. They are holding their new, larger positions. The only people selling are the small fish. It's a low-conviction pullback.
Precisely. A low-volume pullback is healthy. It means the market is digesting the massive gains. The big elephants are resting, waiting to resume buying. But let's look at the dark side. What if the pullback on day 2 happens on high volume? What if it drops 4% and trades 45 million shares?
Well, that would mean the institutions are the ones selling.
Exactly. That is a massive blaring red flag. It means the institutions didn't believe the earnings report. They used the massive day one retail excitement as an exit liquidity event.
Oh, wow.
They use the high prices to quietly dump millions of their own shares onto unsuspecting retail traders.
So?
If you see a high-volume pullback, the PA thesis is dead. You cancel the trade immediately and walk away.
Okay, this is brilliant. So by forcing yourself to wait for this low-volume consolidation for 3 days, you are accomplishing 2 massive things. First, you are validating the institutional thesis. You are proving the big money is staying in. But second, and arguably more importantly, you are letting the IV crush happen without you.
Exactly.
Over those 3 days, the options market calms down. The volatility premium evaporates. The options become cheap again. You're letting the fast money get shaken out. You're essentially trading a slightly higher entry price on the stock for a massive, massive reduction in options risk. You have entirely removed the blind box gambling element from the trade.
You've perfectly summarized the mathematical edge. But again, it requires anti-human psychology. When a stock pops 15%, your human instinct is pure greed. You want to buy instantly. The blueprint says no. Then, when it dips for 3 days and the financial media starts writing articles saying the AI rally is dead, the stock is failing, your human instinct is pure fear. You want to stay away.
Right, you think it's over.
But the blueprint says buy. You must buy exactly when others think the momentum is over.
Which brings us to the final step, Pillar 3, the entry. Once you've confirmed the massive trigger and you've verified the low-volume pullback over 3 days, how do you actually execute the trade? What are you buying?
The sources are highly specific here to mitigate risk and fight theta decay. You do not buy far out of the money lottery tickets. You do not buy options with strike prices 20% higher than the current price.
What do you buy then?
You buy in the money or at the money call options.
Let's explain why. An at-the-money option has a strike price exactly where the stock is currently trading. Why is that safer?
Because ITM and ATM options consist mostly of intrinsic value. They behave much more closely to the actual underlying stock price. They have a higher delta.
Meaning they track the stock better.
Right. If the stock moves up $1, your option moves up 50 or 60 cents. They are far less sensitive to any lingering volatility drops. And crucially, you must buy time. You do not buy options expiring this Friday. You buy contracts expiring 30 to 60 days out.
Going back to the hotel analogy, you are booking a room for 60 days. So if you hold it for 10 days to capture the institutional drift, the theta decay on a 60-day option is barely noticeable. You have plenty of time value left to sell to someone else.
Exactly. You are giving the stock ample time to actually perform the multi-week drift you're betting on without bleeding out from theta.
Okay, this is all incredibly logical in theory. It's a beautiful flowchart. But to prove this isn't just theoretical, whiteboard finance, our sources provide a real-world textbook example of this exact strategy playing out flawlessly. Let's move from theory to application. Let's talk about Qualcomm, ticker symbol QCOM.
Qualcomm in early May of 2026 is the perfect specimen for a PEED strategy. Let's walk through the timeline based on our 3 pillars. Qualcomm releases their earnings, the market loves it, and the stock pops 12.6%.
That easily satisfies our 10% trigger.
Yes.
And the narrative driving that pop was incredibly strong. The market fundamentally shifted its view of the company. For years, Qualcomm was seen as a stagnant legacy mobile phone chipmaker. Their fortunes were tied to how many smartphones were sold.
The old narrative.
Right. But this earnings report showed they are suddenly a major player in edge AI and automotive technology. The sources specifically note their automotive revenue jumped a staggering 38%. That is a massive shift in how Wall Street values the future of the company.
It's what equity analysts call a multiple expansion narrative. The market decides the company deserves to be valued like a high-growth tech stock rather than a mature hardware company. So we have the trigger and we have the narrative. Now we watch Pillar 2.
Oh, wait.
Over the next couple of days, the stock pulls back beautifully. It drifts down from the post-earnings high to around $168. And crucially, the volume shrinks significantly, falling to under 30% of the pop day's volume.
It was a textbook, low-volume consolidation. The institutions were holding their ground.
Exactly. The big money wasn't selling. So following the blueprint, a trader steps in on day 3 and buys at the money calls at the $168 price point, with expirations 45 days out.
And then, boom, the consolidation ends. The institutional VWAP algorithms turn back on, and it explodes. From that $168 pullback, it rallies massively over the next few weeks to $186.55.
A huge move.
If you bought those at the money calls during the low-volume dip, your options contracts are suddenly printing massive returns. But I want to dig into the structural mechanics here. Why did Qualcomm bounce back so aggressively? Why was the pullback so shallow? It never had a deep, scary retracement that shook people out.
There were 2 massive structural factors acting as support beams underneath Qualcomm's price. First was its relative valuation. The AI sector in May 2026 is famously expensive, but compared to its peers, Qualcomm was incredibly cheap. Before the pop, it was trading at a price-to-earnings, or PE, ratio of only 23.5x. Compare that to the pure compute players we'll discuss later, trading over 100x.
It was the cheapest, nicest house on a very expensive block. Value-oriented funds felt incredibly safe buying it.
Precisely. But the second factor was even more potent mechanically. Alongside the earnings beat, Qualcomm management announced a massive $20 billion stock buyback program.
Oh, wow. Okay, I have to push back here on the philosophical purity of this strategy.
Sure, go ahead.
If a massive tech corporation is literally buying its own stock in the open market with a $20 billion corporate war chest, aren't we just riding the coattails of corporate financial engineering rather than true market discovery? Like, the stock isn't drifting up just because the free market loves edge AI. It's going up because the company is artificially reducing the outstanding supply of shares every single day.
It's a completely valid critique of modern market structures. But frankly, as a momentum options trader, you shouldn't care about philosophical purity. You care about order book mechanics.
Fair point.
Whether it's pure market discovery or corporate financial engineering, a $20 billion buyback acts like a massive bulldozer sitting underneath the stock price in the order book.
How does that actually look on the trading floor?
When a company executes a buyback, they hire an investment bank to run the algorithm. Every time the stock price dips a few cents, the company's own algorithms step in with massive buy orders at the bid-ask spread. They essentially absorb all the selling pressure.
They just eat the dips.
It creates a mathematically artificial floor. For a trader running a Pete strategy, that is a dream scenario. It virtually eliminates the risk at a deep, volatile retracement, shaking you out of your option position. You have a $20 billion buyer permanently stationed right below you.
Okay, I see your point. Don't fight the bulldozer, just hop on it. And there was also a future narrative catalyst keeping the momentum alive, right?
Yeah.
The upcoming June 24 Investor Day.
Yes. How does a known, scheduled future event sustain a current momentum drift? Because institutions buy in anticipation. They know that on June 24th, Qualcomm's management team is going to get on a stage in front of the financial press and outline a grand, multi-year, highly optimistic vision for their edge AI and automotive pipeline.
Right. The CEO is going to paint the rosiest picture possible.
Exactly. And no institutional portfolio manager wants to be caught short or underweight on the stock going into an event that is explicitly designed to pump the company's future prospects. It acts as a temporal magnet, continuously pulling the price upward through the drift period as funds position themselves for the event.
So the setup is perfect, the execution is flawless, the buyback supports the price, and you are sitting on massive life-changing profits from those calls you bought at $168. But the sources are very strict about what happens next, because this is where human greed usually destroys a good trade. Trade management. You don't just hold on forever and hope the stock goes to infinity so you can buy a private island. What are the exact risk management rules here?
The sources outline the golden rule of options momentum trading, and it is non-negotiable. If your call options have doubled in value, if you hit a 100% game, you must sell exactly half of your position immediately. No questions asked.
So if I bought 10 contracts for $1,000 each, $10,000 total, and they go to $2,000 each, I sell 5 of them, I put my initial $10,000 principal right back into my cash account.
Exactly. The psychology of this is paramount. You have just turned a stressful, high-risk options gamble into a zero-cost mathematical free roll. You literally cannot lose your original money anymore. The remaining 5 contracts you hold are purely house money.
That is massive for mental health and trading.
At the exact same time you sell half, you adjust your stop loss on the underlying stock. For Qualcomm, once the stock hit the mid-180s, the sources advise moving the mental stop loss up to $175, meaning if the broader market crashes tomorrow and Qualcomm falls back down below $175, the upward drift thesis is technically broken.
And then what?
You immediately sell the remaining house money options to lock in whatever profit is left.
It entirely transforms the psychology of the trade. You go from sweating every single red tick on the 5-minute chart, heart racing, to literally sitting back, going for a walk, and letting the market do whatever it wants. Because the worst case scenario is a break even, and the best case scenario is unlimited upside on the remaining contracts.
Discipline is the only thing that separates a professional trader from a degenerate gambler.
Okay, so Qualcomm is the textbook, safe, low valuation success story. The multiple expansion played out perfectly. But we're talking about May 2026. The AI supercycle is a raging inferno. What happens when we try to apply this exact same 3-pillar strategy to the absolute apex predators of the AI bubble?
The dangerous ones.
The stocks that are trading at astronomical nosebleed multiples. Let's transition away from the bulldozer and let's walk directly into the volcano. Let's talk about AMD.
This is where the strategy moves from textbook execution to walking a tightrope over a canyon. Let's set the scene. It is May 5th in our timeline, and AMD has just released its Q1 earnings after the closing bell.
And the fundamental numbers are staggering. The sources note that their data center revenue, the holy grail of AI chips, is up 57% year over year. The stock is soaring 15% in after-hours trading, rocketing past $400 a share to hit around $411. And here is the kicker. The number that makes traditional value investors physically nauseous, its price-to-earnings ratio, is a staggering 136.1x.
136 times trailing earnings. To put that in perspective, you are paying $136 for every $1 of actual profit the company makes. The market is pricing in a decade of absolute flawless execution and monopolistic growth.
So let's apply our strategy. Pillar 1, the trigger, is easily met. Massive 15% pop, massive volume. They gave beat and raise guidance because they announced their newest AI chips are completely sold out for the next 4 quarters.
The narrative is bulletproof.
So the amateur retail instinct is to wake up tomorrow morning, May 6th, log into their brokerage, and buy AMD calls right at the 9:30 a.m. open to catch the rocket ship to $500.
And the expert commentary in the sources issues a stark, blaring, multi-paragraph warning. Buying AMD calls at the open tomorrow is financial suicide.
Because of the IV crush we talked about earlier.
Yes, but amplified by the sheer insanity of the valuation. When a stock with a 136x PE jumps 15% overnight, the options pricing models become completely unhinged. The implied volatility isn't just high, it's at a fever pitch. Market makers are terrified of the velocity.
So the premium is insane.
The premium you are paying for an AMD call at the open is almost entirely composed of pure, unadulterated FOMO. If you buy at the open, you are buying the absolute top of the volatility curve.
So the strategy absolutely demands that you wait.
You must wait 2 to 3 days. You must see if the chart fills the gap, retreating back to the $385 to $395 range to digest the move. And crucially, you must see if the trading volume drops from the post-earnings frenzy of 80 million shares down to a normalized, quiet 20 to 25 million shares.
Here's where it gets really interesting, because the psychology required to wait here is agonizing, like stomach churning. If AMD's CEO just announced on national television that they are completely sold out of their flagship AI chips until the end of the year, waiting 3 days feels like watching the last train out of town leave the station without you. Are we absolutely sure it will ever come back down to $385? Doesn't the strategy risk missing the entire move if AMD just keeps rocketing?
It absolutely does risk missing the move, and that is a feature of the strategy, not a bug.
Right.
If AMD continues to gap up and run to $450 without ever consolidating, without ever showing volume decay, the professional trader simply shrugs and walks away. You do not chase.
Well, just let it go.
Yes. Because the math of chasing a 136x PE stock with hyperinflated peak 5-year options is a statistically losing game over the long run. You might get lucky once, but if you do it 10 times, the IV crush will bankrupt you. But in this specific case with AMD in early May, there is a very specific looming reason why waiting is critical, beyond just normal chart consolidation.
The shadow of ARM.
Exactly. ARM Holdings, the massive semiconductor design company, is scheduled to report its own earnings tomorrow, May 6th. And ARM is sitting at a PE of over 100x, having already gained 84% year-to-date.
Their expectations are priced for absolute divine perfection. So how does ARM's earnings report mechanically affect a trade on AMD? They're different companies.
It's about systemic risk and sector correlation. The entire AI semiconductor sector, NVIDIA, AMD, ARM, Broadcom, is packaged together in massive semiconductor ETFs like the SMH. They trade almost as a single massive entity.
Oh, I see.
Furthermore, their supply chains are linked. ARM licenses the architectural designs. AMD and others build custom silicon based on it. If ARM reports tomorrow, and their royalty guidance is merely great if they just meet expectations instead of shattering them into a million pieces, the market will viciously punish them for not justifying their 100x multiple.
It becomes a classic sell the news event. The institutions take profit.
Precisely. And if ARM drops 10% because they only had a great quarter instead of a miraculous one, the algorithms will aggressively sell the entire semiconductor ETF. They will drag the entire sector down with them. NVIDIA will drop. And AMD, sitting up there at $411 on a 15% gap up, will get pulled right back down into the gap by the ETF selling pressure.
Oh, that is brutal. So if you ignored the rules, if you bought AMD calls at the open on May 6th, paying peak IV prices, and then that afternoon ARM reports a slightly weak quarter and causes a sector-wide dip, you're utterly obliterated.
You would lose 80% of your options premium in 24 hours. The delta drops as the stock falls, and the IV crushes simultaneously. The sources use a chilling, visceral phrase for buying AMD calls on day one under these conditions. It is like picking up gold coins inside a volcano.
I love that imagery.
You might get a few pieces of gold, but the eruption is mathematically guaranteed to vaporize you eventually. So if AMD is a volcano that's too hot to touch, and ARM is a looming wild card that could ruin the entire sector, where does the momentum trader look? If you want to apply this strategy without standing inside an active crater, we need alternative targets.
If the pure compute ships the NVIDIAs, the AMDs are the apex predators trading at 100x multiples, the smart capital looks for the secondary ripple effects, the trader needs to pivot to the infrastructure side of the AI boom, the picks and shovels. Our sources point us directly to 3 specific hardware companies: DL, MRVL, and HPE.
Okay, so AMD is the volcano. Qualcomm has the buyback bulldozer, and now we are looking at the companies actually building the physical metal, wires, and server racks that house these chips. And what's fascinating is how the sources break down the distinct personalities of these 3 infrastructure stocks. They all provide AI hardware, but they require entirely different trading tactics. Let's start with DL.
DL is the steady giant of the group. In early May, they are trading at $216.32 with a very reasonable, almost comforting PE of 31.4x. They aren't designing the miraculous AI chips, but they're building the massive, incredibly complex AI servers that integrate NVIDIA's chips with specialized liquid cooling and power delivery. The sources note they have a reported backlog of $43 billion in orders.
$43 billion just sitting there waiting to be fulfilled. Let's talk about what that actually means mechanically. That's a massive safety net.
It is the ultimate price floor. When a company has a $43 billion backlog of tangible hardware orders, it means their revenue for the next 2 years is virtually guaranteed, bottlenecked only by how fast they can get parts for NVIDIA. Institutions love this because revenue recognition becomes highly predictable.
So it trades differently.
Because of this, Duell's trading personality is very different from AMD. It doesn't usually do wild, erratic 20% swings. Its post-earnings behavior is typically a high open, followed by a horizontal consolidation.
It doesn't pull back deeply because the institutions know exactly what it's worth. It just moves sideways for a few days to digest the gains. A high flag.
Precisely. So for Duda, the PED strategy adapts. You aren't waiting for a deep, painful dip to shake out weak hands. You are simply waiting for the stock to trend sideways and just lightly touch its 10-day moving average on a chart maybe around $205 to $210 and hold steady on low volume. That touch of the moving average is your entry point.
Okay, steady freight train. Now what about MRVL, Marvell Technology?
MRVL is a completely different beast. They are trading at $168.75 with a much higher PE of 54.9x. They don't build the servers, they build the optical modules and custom ASIC chips. They provide the highly specialized plumbing that connects thousands of AI servers together in a data center so they can talk to each other at the speed of light.
And the sources describe MRVL as highly volatile. They call it a high beta stock.
Yes. Beta is a measure of volatility relative to the broader market. A beta of 1 means it moves exactly with the market. A high beta means if the market twitches, MRVL swings wildly. If DL is a heavy freight train that is hard to stop, MRVL is a high-performance sports car driving on a wet track with no traction control.
That sounds dangerous.
Because of its valuation and its high beta, every tiny macroeconomic rumor sends it spinning out.
Yeah.
It is incredibly prone to explosive upward moves, but equally prone to violent fake breakouts that crash back down just as fast.
You absolutely cannot trade MRVL the same way you trade DL.
If you try, you will get stopped out constantly. If MRVL pops on earnings, the strategy dictates that you must wait for a deep, painful pullback. You might have to wait for it to retrace all the way down to $155 or $160 before you even think about buying a call option. You have to let the volatility crush completely, and you have to let the weak retail hands get shaken out by the scary red candles.
It's amazing how much of this strategy is reliant on deeply understanding the unique historical psychology of how a specific ticker symbol trades. The sources actually point out that MRVL's next earnings are May 27th, so they're basically telling the trader, set an alarm on your phone for May 27th, expect a wild swing, and be ready to execute the deep pullback playbook. But then we have the third infrastructure play, and this one breaks the mold entirely. HPE Hewlett-Packard Enterprise, trading at $28.57 with a PE of just 14.5x.
By far the cheapest stock in the AI room.
Right. And I have to play the skeptic here. If HPE is building AI infrastructure and it's trading at 14.5x earnings, why wouldn't we just park all our money right there? Why chase the expensive, volatile ones like MRVL or wait for the sideways grind of Dale? If the whole sector's going up, isn't buying the cheapest, most deeply discounted asset the smartest, safest move?
It is a logical question, but it depends entirely on what specific game you are playing. If you are playing the game of value investing, if you want to buy a stock, put it in your retirement account, collect a 2% dividend, and check back in 5 years, then yes, HPE is a highly rational, safe choice. But we are discussing a momentum options trading strategy. P8 requires explosive, undeniable momentum to function.
And HPE doesn't have explosive momentum.
Exactly. The sources note that HPE is a slow-moving, highly mature, heavily bureaucratic legacy company. It rarely pops more than 10% on earnings, ever. It completely lacks the narrative FOMO required to create a multi-week institutional drift. If you apply the PED strategy to HPE, if you buy short-term, 45-day ATM calls, the stock simply won't move fast enough to overcome the fate of decay. Your options will slowly bleed to death while the stock goes up a few pennies a day.
You'll be right about the company, but wrong about the velocity.
Right. For a low beta value stock like HPE, the strategy suggests a completely different tool. Long-term equity anticipation securities. These are call options that expire a year or two out. You buy a LAPS contract on HPE and treat it as a long-term leveraged investment, not a short-term momentum trade. You give it 18 months to slowly realize its value.
So this entire breakdown of the infrastructure spectrum, the high multiple chips, the steady server builders, the volatile networking plumbing, and the legacy value plays it tells us a much deeper macroeconomic story about capital rotation in May 2026, doesn't it?
It does. It shows the market ecosystem hunting for efficiency. As the pure compute chips get incredibly expensive and crowded as AMD hits, that 136 XPE and NVIDIA becomes a multi-trillion-dollar behemoth smart institutional money, starts looking for cheaper, less crowded ways to play the exact same AI theme. They rotate their capital out of the volcano and into the picks and shovels, the servers, the cooling systems, the optical cables.
Rotation.
That underlying tidal wave of capital rotation is what provides the structural support for these PED setups in stocks like DL and MRVL.
Okay, so we've covered the hardware side exhaustively. We understand the chips, the servers, and the infrastructure. But there's a whole other sector showing these exact same post-earnings drift patterns, and it brings us to the software side of the AI boom. And I have to warn you, the listener, this is where the underlying mathematics of the options market start to get really, really crazy. Let's talk about software, standoffs, and the gamma squeeze. The specific focus in our sources is Atlassian, ticker symbol TEAM.
This is perhaps the most fascinating and dangerous setup in the entire deep dive. Atlassian, a major enterprise software company, reported earnings on May 1st, and their cloud revenue exploded, largely due to successful AI integration into their enterprise workflows. The market realized they weren't just a project management tool, they were an AI productivity engine.
The stock gapped up massively, nearly 30% overnight, rocketing from around $68 to roughly $92. Let's run it through our Pillar 1 checklist. Huge pop, yes, 30%. Massive volume, yes, an incredible 27 million shares traded on day one. And now we are in Pillar 2, the consolidation phase.
And it is forming a perfect high flag consolidation pattern. Over the last few days, the volume has beautifully and systematically decayed down to just 5 to 7 million shares a day. But here's the critical detail that makes this setup unique. The stock refuses to drop.
It's just stuck there.
It absolutely refuses to fill that massive $24 gap from $68 up to $92. It is just hovering tightly in the low 90s, completely standoffish.
Which means the sellers are completely exhausted, and the buyers are just holding their ground, refusing to give up an inch. But the surface level chart is only half the story. What is happening under the hood in the options market is what makes this a powder keg. The expert in the sources introduces two highly technical concepts that we need to break down mechanically: 4V right skew and OTM call stacking. Let's start with IV right skew. Explain that like I'm new to options pricing.
To understand right skew, we first need to establish what normal market conditions look like. Normally, the options market is structurally paranoid. Portfolio managers buy puts options that give them the right to sell the stock at a set price, betting it will go down as insurance for their massive stock portfolios.
Okay.
Because everyone constantly wants insurance against a crash, put options generally have higher implied volatility and therefore cost more than call options. When puts are more expensive than equally distanced calls, the volatility curve leans to the left. It's called a left skew.
That makes sense. Fear usually costs a premium. You expect to pay more for fire insurance than for a lottery ticket.
Exactly. But with Atlassian right now, in May 2026, the exact opposite is happening. The curve has inverted. Calls are becoming significantly more expensive than puts. The volatility curve is skewing sharply to the right.
Let me make sure I'm following the psychology of this. If calls are suddenly commanding a massive premium over puts, doesn't that mean the entire market has shifted from a structural fear of crashing to pure, unadulterated FOMO?
That is exactly what it means. Greed has violently overtaken fear. Market participants are so utterly terrified of missing the next 20% leg up in Atlassian that they are willing to overpay drastically for call options while completely ignoring downside insurance. And this ties directly into the second concept, acting as the detonator. OTM call stacking. OTM stands for out of the money.
Meaning people are buying call options for strike prices that are way higher than where the stock is currently trading.
Right. The stock is hovering stubbornly at $92, but the sources show massive, highly abnormal accumulations of call options being bought at the $100, $100, and $110 strike prices for the June and September expirations. Both retail traders and aggressive institutional hedge funds are stacking these massive directional bets, expecting a violent, explosive move upward.
And this specific combination, the Ivy right skew showing extreme greed, and the massive stacking of out-of-the-money calls at $100 creates the perfect storm for a market phenomenon that I find absolutely terrifying but mesmerizing to watch.
Yeah.
The gamma squeeze. Walk us through the step-by-step mechanics of a gamma squeeze. How does me buying an option contract mathematically force the actual underlying stock price to go up?
It all comes down to the risk management algorithms run by the market makers. When you log in and buy a call option, you aren't usually buying it from another retail trader. You are buying it from a market maker, a massive financial institution like Citadel or Virtu, whose sole job is to provide liquidity.
Right.
But market makers do not want to take directional risk. They are not in the business of betting against you. If they sell you a call option, giving you the right to buy 100 shares of Atlassian at $100, they are heavily exposed. If the stock rockets to $110, they have to sell you shares at $100, and they take a massive loss.
Okay, I'm going to act as the market maker here.
Yeah.
I just sold you a call option for Atlassian at $100. The stock is currently at $92. I'm nervous. How do I mathematically protect myself so I don't go bankrupt if you're right?
You hedge. The millisecond you sell me that call option, your computer algorithm goes into the open market and buys a certain amount of actual Atlassian stock. The exact number of shares you buy is determined by an option Greek called delta.
Delta. Okay, explain delta.
Delta measures how much the option price moves for every $1 the stock moves. But for a market maker, delta represents their hedge ratio. Because the stock is currently at $92 and the strike is $100, the option is out of the money. Let's say it has a delta of 0.30.
What does that mean for my algorithm?
That means to perfectly neutralize your risk, your algorithm immediately buys 30 shares of Atlassian stock to hedge the 100-share option contract you just sold me.
Okay, I follow. I sold you the contract. I bought 30 shares. I am perfectly neutral. If the stock goes up or down, my gains on the shares cancel out my losses on the option contract. I am safe.
You are safe for now. But here is where the trap springs and where the gamma squeeze is born. Delta is not a static number. As the stock price naturally rises from $92 up to $95, getting closer to that $100 strike price, the probability of that option paying out increases. Therefore, the delta of that option increases. It goes from 0.30 to, say, 0.50.
And gamma is the rate of that change.
Yes. The rate at which delta changes is called gamma.
Wait, let me process this.
Yeah.
If the delta just changed from 0.30 to 0.50 because the stock ticked up, my algorithm is suddenly underhedged. I only own 30 shares, but the math says I now need to hold 50 shares to stay neutral.
Exactly. So your computer algorithm, completely devoid of emotion, violently fires off a market order to immediately buy 20 more shares of Atlassian stock at whatever the current price is, just to stay perfectly neutral. Now, multiply this tiny interaction by the hundreds of thousands of OTM call contracts that have been stacked on Atlassian at $100 and $110.
Oh my God. As the stock just organically starts to creep up from $92 to $94, every single market maker on Wall Street is suddenly mathematically forced by their own risk management algorithms to blindly buy millions of shares of the underlying stock to constantly dynamically hedge their options exposure. And their massive forced buying pushes the stock price even higher.
Which increases the delta again. It pushes the delta to 0.70, which forces the algorithms to buy even more stock. It is an upward, violent, completely self-fulfilling spiral. The algorithms are chasing their own tails, driving the stock price to the moon. That is a gamma squeeze.
Wow.
The options market tail is literally violently wagging the dog of the equity market. Fundamentals no longer matter. It is purely a structural plumbing crisis.
That is absolutely incredible to visualize. It's a chain reaction. So knowing this massive powder keg of unhedged gamma is just sitting there on Atlassian waiting for a spark, what is the exact tactical advice from the sources for a trader looking at this on May 6th?
Because the stock is standoffish and refuses to dip, you can't wait for a traditional deep pullback. You can't wait for $85. The strategy must adapt to the setup. The sources advise taking a starter position. You buy just a partial position, maybe 1 or 2 contracts, instead of your usual 10 of the June 18 expiration calls at the $95 strike, while the stock is hovering quietly around $91 to $92.
You buy a little bit just to get your foot in the door. Because if the gamma squeeze triggers, it'll happen so fast you won't be able to get in.
Correct. You establish a foothold. If the stock organically crosses $95 on high volume, the market maker's delta hedging will kick into overdrive. The squeeze is likely initiated, and you can ride that forced algorithmic buying all the way up to $100 or $110, potentially adding to your position on the way up. But, and this is the most critical part of trading a gamma setup, you must have a ruthless mechanical stop loss.
Because if the squeeze fails, it crashes just as fast.
Exactly. The sources set the strict mental stop loss at $88, which was the absolute low of the initial earnings gap day. If Atlassian falls below $88, it means the buyers have finally exhausted themselves. The gap is starting to fill. The market makers will start unhedging, selling their shares, accelerating the crash downwards. If it hits $87.99, the squeeze thesis is dead, and you cut your losses immediately without hesitation.
Which brings us perfectly to the final piece of the puzzle: defense, hedging, and portfolio preservation. Because we just talked about setups that offer astronomical upside. The sources mentioned potential 1-to-5 risk-to-reward ratios during a gamma squeeze. You risk $1,000, potentially make $5,000 in a week, but the brutal reality of options trading is that if the squeeze doesn't trigger, or if the P drift fails to materialize, these call options can and absolutely will expire worthless. They go to zero. How does a professional trader survive that variance? How do they defend the portfolio?
They survive by recognizing that even with a highly refined, mathematically sound, high-probability setup, even with that historical 65% to 75% win rate we discussed earlier, systemic macro risk is always present. You could have the absolute perfect Pete setup on Atlassian, the volume decay could be flawless, the gamma could be stacked. But if the broader markets, say, the NASDAQ 100 index, the QQQ suddenly tanks 3% on a Tuesday because the Federal Reserve unexpectedly raises interest rates, or because of a geopolitical shock, the macro tide goes out, and it will drag your individual high-beta AI stocks down with it. A rising tide lifts all boats, but a receding tide sinks them all, regardless of their individual earnings reports.
Right. If the whole market is panicking, nobody's stepping in to buy Atlassian at $95. So you have to mathematically hedge against the macro environment. What specific defensive tactics are outlined in our sources?
The sources outline 2 primary methods for portfolio defense. The first is active insurance, using QQQ bear put spreads.
Break that down. What is a bear put spread?
It is a defined risk options strategy applied to the broader market index. Instead of just buying a standard put option on the NASDAQ, which can be very expensive due to implied volatility, you buy a put at, say, this $440 strike price and simultaneously sell a put at the $430 strike price.
Oh, I see. Selling the lower put generates a credit, which drastically reduces the total cost you paid for the insurance.
Exactly. It caps your maximum potential profit if the market completely crashes, but it makes the insurance incredibly cheap to maintain week over week. If the whole market suffers a macroeconomic shock, this bear put spread position makes money, which mathematically offsets the losses you are taking on your individual AI stock calls. It's affordable macro insurance.
That's brilliant. What's the second defensive method?
The second method is about generating passive income while you wait for the perfect setups. The sources recommend using cash-secured puts, specifically backed by SGOV.
Okay, let's unpack this one step at a time. What is a cash-secured put?
Selling a put option means you are acting as the insurance company. You get paid a cash premium up front. In exchange, you agree to buy 100 shares of a specific stock at a specific lower price if the stock falls to that level. The cash secured part means you must keep enough cash in your brokerage account to actually buy those shares if you are assigned. So if I really want to own Qualcomm for my long-term portfolio, but I think $180 is too expensive, I can sell a put option at the $160 strike price. Someone pays me, say, $300 in premium today. If Qualcomm stays above $160, I just keep the $300 for free. If it drops to $150, I'm forced to buy it at $160, but I wanted to buy it there anyway.
Exactly. You get paid to wait for your target price. But the sources add a brilliant optimization. You don't just leave that collateral cash sitting in your brokerage account earning 0%. You buy SGOV, which is a highly liquid ETF that holds ultra-short-term U.S. Treasury bonds. Because they are ultra short term, they don't fluctuate in price, making them virtually risk-free collateral.
So wait, let me do the math on that. I am holding my cash in SGOV, earning a guaranteed 5% annualized yield from the U.S. government. My broker allows me to use that SGOV position as collateral, so I sell the put option against it. I'm stacking the 5% risk-free treasury yield on top of the options premium I just collected for selling the put.
Yes, you are double dipping on yield. It is a highly efficient use of capital. I have to point out the extreme mental friction here, the psychological whiplash. You are asking a retail trader to be a hyper-aggressive, bloodthirsty momentum hunter, tracking volume decay, analyzing multiple expansions, and hunting for explosive gamma squeezes on high-beta AI stocks.
It's a lot.
But at the exact same time, in the exact same portfolio, you're asking them to be a conservative, math-driven actuary, meticulously selling put spreads to reduce cost basis and stacking 5% treasury yields. How does a human trader reconcile those two completely opposite mindsets without going crazy?
It is difficult, but it is achieved by understanding that these strategies serve completely different functions in the ecosystem of a portfolio. Think of your portfolio as a medieval kingdom. The defensive strategies, the SGOV yields, the cash-secured puts, the QQQ insurance set, they are the fortress walls. They are boring, they are sturdy, and they ensure that the kingdom survives a siege. They ensure you survive to trade another day. The aggressive PED strategies, the AMD and Atlassian call options, they are the raiding parties. You send them out from the safety of the fortress to capture high, explosive returns. But you never, ever risk the fortress itself to fund a raiding party.
This ties perfectly back into the trade management rule for Qualcomm, the golden rule. When it doubles, take half off the table.
Precisely. If your raiding party finds gold, you don't let them stay out in the wilderness gambling it away. You send half of that gold back behind the fortress walls immediately. You lock it in SGOV. You do not marry the trade. The entire PED strategy relies entirely on predefined cold-blooded rules. If the volume on the pullback doesn't shrink, you don't buy. If the stock breaks the day one low, you cut your losses. You are executing a flowchart. You are not riding an emotional roller coaster.
Which brings us to our summary. We have deconstructed a massive amount of market mechanics today. We started with the amateur urge to chase day one earnings, paddling blindly right into the breaking wave, and we learned how they get mathematically crushed by implied volatility and theta decay.
We learned why that IV crush makes day one buying a statistical trap, and why patience is the ultimate edge.
And we laid out the professional blueprint, the trigger of a 10% pop, 3x volume, and a clear windshield of a beaten race. The consolidation period, tracking the forensic footprints of institutional VWAP algorithms through volume decay, waiting exactly 2 to 3 days for the fast, weak money to leave.
And finally, the entry. Buying in the money or at the money calls with 30 to 60 days to expiration, actively fighting the war against time and volatility by waiting for a much higher probability de-risked setup.
We saw it work flawlessly in Qualcomm, aided by the bulldozer of a $20 billion corporate buyback and a low multiple. We saw the intense dangers of the high-valuation Volcano and AMD and the systemic correlation risks of ARM triggering a sector-wide sell the news event. We explored the infrastructure spectrum, the steady $43 billion backlog freight train of Dell, the highly volatile wet track sports car of Marvell, and the slow value play lead piece strategy for HPE. And we dove deep into the complex, dangerous, but incredibly lucrative mechanics of gamma squeezes and IV right skew in software stocks like Atlassian.
It is a comprehensive mechanical framework for navigating one of the most volatile, confusing, and opportunity-rich environments in financial history, the 2026 AI supercycle.
But I want to leave you, the listener, with a final provocative thought. Something to mull over on your commute that wasn't explicitly covered in the mechanics today. Think about the constant, never-ending arms race of information in the market. Today, we are talking about how retail traders can use this 3-day volume decay pattern to gain a 70% win rate edge against the market. But Wall Street institutions, the Citadel and Renaissance technologies of the world, run machine learning algorithms that are infinitely more powerful than anything we possess. As retail traders become more sophisticated, as deep dives like this explain these mechanics, and everyone universally starts identifying and exploiting these 3-day pullback patterns, will the Wall Street algorithms simply change their behavior to trap this new strategy?
It is the ultimate financial game of cat and mouse. The market is a living organism that adapts to those trying to harvest it.
Yes, exactly. If the Citadel algorithms know that smart retail money is waiting patiently for day 3 to buy the low-volume dip, Does the institution intentionally initiate a massive, fake, high-volume sell-off on day 4 to trigger everyone's stop losses, shake the retail traders out, and then drive the price up to the moon? Does the institutional drift intentionally start happening on day 5 instead? Or do they accelerate it to day 2? In a modern market entirely governed by AI and algorithmic warfare, an edge is only an edge until everyone knows about it. You have to stay agile. You must constantly question the permanence of any pattern, because when you're looking at that diagnostic X-ray of the market to find your perfect setup, sometimes the machine itself is changing the picture while you're looking at it. Keep your stop losses tight, and we'll see you next time.